Hey everyone, welcome to another dividend stock investing video. I am excited in the video today to cover a dividend stock that many believe is a value right now. This is a core dividend stock, consumer packaged goods company with a starting dividend yield of 4%. It has fallen off of a cliff this last week, so to speak. It's recovered a little, but in general, it has been trending down, and it's trading at a price earnings ratio around 17 right now, which is unheard of in this market. I want to dig into Unilever company, ticker UL. I want to go beyond the headline news and into some of the details, into what is fundamentally affecting this company and why it's trading on discount. What is going on with this company? I'm going to compare it a little bit to Procter & Gamble, ticker PG, another dividend stock that I own. And so more context can be revealed around why Unilever is trending down so much. In my personal opinion, it's interesting right now for Unilever company. It's an interesting time, and I'm probably going to buy some more myself because of what's happening at Unilever. Get ready, everyone. I have a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I'm really excited about the video today. Before I get started, just a quick note that my setup today is a little bit different. You're going to see in the next few videos, I'm going to be bumping around to different setups for my videos. My garage setup has been retired as of this time because we are in the process of starting to move some of our belongings to our new place. For all of you that were guessing, we are going to be moving to the Greater Boise, Idaho area. My patrons already know that and they know the full story behind it, but put in the comments below if you live in the Greater Idaho area, Boise, Idaho area. Would love to know. Put in the comments below. If so, I'm going to be your neighbor, and so it's going to be a lot of fun. But with all of the moving, my old setup in the garage is gone, and now I'm going to have some makeshift setups over the course of the coming months. And so thank you everyone for your support. And by the way, if you'd like to be on my Patreon, check out the pinned comment below. I will have a link to it there where you can learn what that's all about. There's a lot of great value over there. And so let's talk about Unilever. As you can see on the screen in front of you right now, what is going on with this company? Why is it tanking? The first thing I want to do today is just share the news. And so Unilever is basically over, I'd say, the last month. It really leaked just this last weekend, but they're going after the consumer healthcare division of GlaxoSmithKline. Actually, this consumer health division of GlaxoSmithKline is joint owned with Pfizer. Pfizer owns a portion of that, and I do own Pfizer stock as well. But Unilever has been bidding for that division of GlaxoSmithKline, and they recently went as high as 50 billion pounds. Remember, Unilever is a UK-based company. Historically, it was a Dutch-UK dual structure company, but they have done some reorg. Now it's just based in the UK in terms of its stock. And so they are making this bid for GlaxoSmithKline, 50 billion pounds. Unfortunately, it was rejected, but just based on that news alone, the stock plummeted. In general, when a company makes an acquisition, the company making the acquisition will go down in price. The company that's being acquired will go up in price. The reason for this is most of the time in modern times, companies that are making acquisitions, they tend to overpay a little bit. And I think the market really looked at this announcement as Unilever potentially overpaying. There was some news that came out from analysts that even thought, hey, equity. Unilever, if they take on debt to do this, it's going to mess up their balance sheet. It's going to downgrade their debt rating. And so a lot of this played into the stock price. I think part of it as well is it looked a little bit desperate. We know that consumer health divisions of these companies, looking at Procter & Gamble as a comparable, are doing really well. That's a division within Procter & Gamble that's growing really quickly. And so I think this signals to analysts that Unilever is looking for growth. Their growth has been slow. It's been slower than peers like Procter & Gamble. And so I think this signaled that not only would they maybe be overpaying, but it also signaled that management was just searching for growth that they're not finding internally. Hence, the stock went down even further than it had been already. I know a lot of dividend stock investors that I follow on Twitter have been snapping up shares. Check out the pinned comment below. I will link to my personal Twitter. I'm pretty active over there on Twitter, so check that out. But it's interesting. I know a lot of dividend investors looked at this as an opportunity. In general, I look at it as an opportunity as well because I'm a long-term holder and I plan to hold Unilever forever. So I'll probably be picking up some shares at these low levels with this high starting yield. And with that, as you can see on the screen right now, let's just go through a few metrics. And so the first thing you're going to see on the screen right now are these charts. I actually have Unilever and Procter & Gamble here. Unilever, you can see it's been languishing in recent years. It's been trending sideways. Most recently, it's been going down, whereas Procter & Gamble has been up and to the right, but over long eras of time, both stocks are going up quite significantly. Now, Unilever and Procter & Gamble really are a tale of two stocks because they're trading at entirely different valuations. So the price per share on Unilever is $49.40, and the forward analyst estimate is actually the same as it was basically the last year. The earnings per share are not growing very quickly for this company at all right now, hence their bid for that consumer healthcare division of GlaxoSmithKline, but it basically puts their forward PE at a 17. Now, by comparison, you can see for Procter & Gamble, which is growing pretty quickly, their forward PE is at a 27. So this is trading at 10 points lower in terms of forward PE because of its slower growth and because, quite frankly, the market probably isn't as efficient as we all think it is. I love both companies, by the way. The dividend on Unilever is 49.75 cents or $1.99 per year. This is on the ADRs, the UL shares, and that we can buy here in the United States, and it's trading at a starting dividend yield of 4%. But this 4% is not as exciting as it looks because the payout ratio is 70%. That's a bit too high in my humble opinion, but I think getting a 4% starting yield on Unilever is amazing. I would not expect it to grow too quickly here because that payout ratio, I just, as a shareholder, would hope they don't push it too much from here. Procter & Gamble is trading at a starting yield of 2.15%, but with a more manageable payout ratio of 58.88%, there's room for them to increase the dividend just on payout ratio alone, but also because the company is growing. Now, on average, Unilever is growing the dividend by 4.48% per year over the last 5 years. I measured that on the pence, basically, on their website. I got that data from the website to try to get some of that conversion rate issues out of it, currency conversion, because we look at it in US dollars. There's going to be some fluctuations. That's why I'm looking at it in pence. But basically 4.48%. I don't believe that that's going to hold up with the payout ratio being so high and with earnings growth being lower. That being said, I'm willing to forego dividend increases in the next few years for a starting yield so high on such a great company. Now, with Procter & Gamble, they're growing it by 5.39% per year on average. That should keep up. They are strong. And so sales growth at Unilever, the most recent quarter, was 2.5%. And for Procter & Gamble, in the most recent quarter, sales growth was 6%. There's quite a big difference between 6% and 2.5%, hence the premium valuation for Procter & Gamble. It may only look like a few percentage points, but quite frankly, when you compound that kind of sales growth over long periods of time, that makes a big difference, and that's why Procter & Gamble is trading so much higher. Now, Unilever is about 3.1% of my portfolio, Procter & Gamble 5.18%. These are both core important stocks in my portfolio, but Procter & Gamble definitely is more important to me. Now, I would say one thing worth mentioning with Unilever is it can get confusing. It's more difficult to do analysis. This is a UK-based company. It used to be even more confusing because it was a Dutch-UK dual structure, and a lot of their numbers in the reports are in euros, and so it's not based on the same accounting rules all the time as in the US, and so as a US-based investor, there's just a lot more hurdles to jump through to learn how to analyze a company like this. But I love owning this company because it's based outside of the US and it has broad international exposure. It brings that to my portfolio. In 2020, in fact, Unilever ended an era. The Dutch-UK structure now merged into a UK-centric structure. Also worth noting, Unilever shares, UL, are ADRs, or American Depository Receipts. They trade one-to-one with the ULVR shares that trade on the London Stock Exchange. The transfer agent for Unilever here in the United States is Deutsche Bank Trust Company Americas, and they're doing business under American Stock Trust Transfer Company. And it appears they might even be acquired or have been acquired by Equinti. And so that's just something to keep in mind whenever you're buying ADRs, American Depository Receipts. It's important to understand who the transfer agent is, what kind of fees they are taking. Generally, for the luxury of buying an ADR, buying a foreign company that is trading here on the US Stock Exchange, the company behind sponsoring those ADRs typically takes something out of there as a middleman fee. I actually couldn't even get to the bottom of that for this analysis, but it's generally speaking a level at which I am comfortable for the luxury of owning a world-class company that gives me international exposure. And so, as you can see in front of you right now, I want to share some news that came out. This is in actually 2020, but it shows that Unilever officially is no longer a Dutch company. And so this is what I'm talking about, that as of now, it's a UK-centric company. They removed that dual class of shares that were trading in the UK and in Amsterdam. And so that is an evolution of this company over time. Now, as an American buying these shares in the United States, it's important to understand what is this ADR, American Depository Receipt, all about. And so as you can see in front of you right now on the screen, this is some information I got from Unilever's website, Unilever Shares, and it basically just shows you the basics. And it shows that the primary listing for this company is in London. It's ULVR Shares. You can also see, though, it does trade in the Netherlands still, and that is trading as UNA. And then the American Depository Receipt in the United States, which has a one-to-one relationship with the PLC ordinary shares, the ULVR, is traded under ticker UL. And the reason I'm pointing this out is sometimes with these ADRs, it's not a one-to-one mapping. Sometimes an ADR may be only equivalent to like half a share. It could be like half a share of the actual company based internationally, or it could be like 2-to-1 kind of ratios. And so it's important to get to the transfer agent, get to the investor relation website to understand how many shares does your ADR represent. And so we know it's a one-to-one mapping with Unilever. Now, as you can see on the screen in front of you right now, if I were to want to go in and really want to understand more information, Deutsche Bank, how much are they taking, what kind of fee is being paid to own these ADRs, I could contact them at this information here, the email address or phone number that is on Unilever's website. So this is why I spend so much time on company websites, on the investor relations website, because that's where all of the information, it's available. They have it there for all of us investors, and it's really important with ADRs. Now, one thing I also found on the company website is information about the dividend. And so as you see in front of you right now, I go straight to the source to get information about the dividend from Unilever. And what you can see here is they're reporting this information in both pence and also euros. I used pence for my particular analysis, but I would say in general, it's difficult to analyze this company because it's in a foreign currency. It's denominated in non-US dollars. I'm not as used to that, and the way in which certain things are reported, it's a little bit different than what I'm used to seeing, but that's okay. That's part of the fun of it all. What I would say on this dividend that you can just see here, at least as you look in the second column and you look in terms of pence, the dividend per ordinary share, it's really been flat over time. And you can kind of see this even euros, they haven't been reporting it back as far. But you can see euros is absolutely flat. Pence bumps around a little bit because it's being converted between euros and pence. But you can see here pretty clearly that the dividend has been somewhat flat-lined. And so you wonder, why is the starting yield at 4%? You wonder, why is the stock down? Why is it underperforming Procter & Gamble? Why is the payout ratio high? The reason for this, quite frankly, is this company is searching for growth and they haven't quite found it yet. And so you would think, oh, is this just a hidden gem? Am I basically buying the equivalent of Procter & Gamble, which trades at a PE of 27 for a PE of 17? No, this company is not of the quality of Procter & Gamble at this particular moment in time. But as an educated investor and a long-term investor, I'm making the calculated bet that over very long periods of time, looking another 10, 20 years out, maybe it will catch up again to Procter & Gamble. It certainly is a company that has that type of pedigree, and so I'm willing to buy some shares here, but it will never make my top 10 favorite core stocks because it just isn't quite the caliber of company as Procter & Gamble, as we're seeing in some of the metrics so far. Now, I want to go forth, as you can see on the screen right now, it's time to go through some of the performance highlights from their recent quarterly report. And what you can see here is in the third quarter, the underlying sales growth, USG, is 2.5% versus 2020. Now, worth noting, 2020 was a terrible year where sales declined quite considerably. And so I was actually just analyzing McDonald's company earlier today. I was looking at this. I love McDonald's because they do not only a comparison of 2021 versus 2020, but they compare 2021 also to 2019 because they know 2020 was an anomaly year. It was a bad year. I was doing this analysis on the Brandon Beavis Investing Academy. Shout out to my friend Brandon Beavis, by the way. I'll link to his channel in my pinned comment below. I'm a guest presenter over there sometimes on his private investing academy. It's a lot of fun. I spent an hour and a half today analyzing McDonald's on the academy over there. And one of the things, again, I love is they do that 2-year comparison. But as you can see on the screen right now in front of you with Unilever, they're just doing a 1-year comparison and they're saying they're up only 2.5% versus 2020, which was a bad year. And so that's not very exciting. And in terms of the trailing 9 months, their sales growth is up 4.4%. Certainly not the caliber of performance as Procter & Gamble, I'll tell you that. But that's why it's on discount. And so that's the first thing that I noticed with Unilever. The other thing is just you'll see some different metrics, the names for the metrics on their reports. They talk about something called turnover. I believe that's the same thing as sales here in the US. So just something to keep in mind. But that's one of the first thing I saw from their recent financial performance. And now as I dug further into their financial performance, I found out and uncovered some more things as well. And so as you can see on the screen in front of you right now, the next screenshot really goes into some of their segment information by different divisions. And one of the things I love about Unilever is they've got a real healthy focus on beauty and personal care, which I think is an important segment of the market, home care, and then they have foods and refreshments as well. But you can see in terms of turnover for 2021, their single biggest category is beauty and personal care. And so I like that it's a unique position within my portfolio that it offers that exposure. And whenever I'm analyzing financial statements, I love it when they break it down by division to really understand where the money is coming from. You can see at the top of this screen, they show the third quarter and they also show the 9 months as well. And they also break down the sales growth in terms of pricing and volume. And you can see that some of their growth is coming from pricing, some of it is coming from volume. When I look at the 9 months, it looks like for beauty and personal care, 2.3% of the growth is coming from pricing, 0.7% from volume. You can see though in home care, there's actually more of the growth is coming from volume than pricing. And you can see that in foods and refreshment, more of the growth is coming from volume than pricing. And so it just differs by category. But as you look at the total for the 9 months, it looks like about half is coming from pricing, half is coming from volume. I remember when I was reading their report and I was going through the details, I remember somewhere in there that their management was talking about the fact that they are seeing inflation at their company in terms of input costs, and they are passing that along to the consumers. So we're seeing now as consumers that the price of everyday ordinary goods that Unilever sells, they are going up. And that's what they're talking about when they say pricing. When they're talking about volume, they're talking about the amount of product that they're selling, the actual business expansion. I personally always prefer growth to come from volume versus pricing. And that being said, it is nice to see that the pricing strategy is working for them here. Let's keep going. As you can see in front of you right now, the next thing that they show is the geographical breakdown. I like to look at things this way just to understand how a company is divided in terms of their revenues. And you can see in terms of, I'm just going to look at the 9 months at the bottom, turnover or revenues. It looks like the vast amount of their revenue is coming from Asia, and it looks like the Americas come next and Europe comes last. But you can see that clearly this is an internationally based company and an internationally focused company in terms of turnover, and that's why I have it in my portfolio. And it shows that underlying sales growth is doing all right in Asia, the Americas, but not so good in Europe. And so that's something else I learned from this particular chart. And one of the things I would say is, as an investor, I've always been interested in diversifying away from America. But quite frankly, right now in America, it's performing really well, even better than Europe, quite a bit better than Europe. But hopefully Europe will catch up. But I think as an investor, it's important to be broadly diversified. And so with that, I want to keep going on the analysis today. But actually before that, if you enjoy the analysis so far, please go ahead and smash that like button. It really helps me out. It helps the videos reach more people. And if you want to see more videos here, I'm really working hard to bring these videos to you during our move, during this time where it's so busy. Please don't forget to smash the like button, and please also subscribe because I have new videos all the time. And please click the notification bell so you receive a notification as soon as my new videos are posted. And share in the comments below, are you one of the dividend investors that bought Unilever this week? And if not, are you considering buying it? I'm in the camp where I'm considering adding to my Unilever shares here over the coming weeks. It'll be really exciting. With that, as you can see in front of you now, I have some more data to go through. This one actually comes from Procter & Gamble. I want to give a healthy comparison of why Unilever is trading where it's trading. You can see that Procter & Gamble announced in their most recent quarter, the second quarter of their fiscal year, net sales growth of 6%. Organic, though, was also up 6%, and that's really special. You can see that the earnings per share up 13%, and core earnings per share 1%. They raised their 2022 sales and cash guidance. They confirmed their EPS outlook, so on and so forth. This is a company that's doing really well. And the key takeaway from this slide, I don't need to go into all the details. It's just that this company is increasing guidance. You don't see that from Unilever. It's that this company is showing aggressive growth on sales and earnings. You're not seeing that from Unilever. And so that's why it's trading at a premium valuation, because the stock market pays higher multiples for quicker growing companies. But should Unilever be trading 10 points lower in a PE than Procter & Gamble, 17 versus a 27? That I don't know. I personally think Unilever, if Procter & Gamble deserves the 27 PE that it's at, I could see Unilever more around a 20, but not a 17. And so I see a little value there. I see a little value there with Unilever right now. Let's keep going. As you can see on the next screen right now, I have some more analysis to share with all of you. This is some more data from Procter & Gamble. This one gives a sense of what's happening with them. They also talk about volume and pricing. And you can see for them, again, about half their growth is coming from volume. About half of it is coming from pricing, just like Unilever, but it just so happens that that growth is higher. It's at a higher clip than Unilever. And you can see with this company, they're also in beauty, they're in grooming, healthcare, they're in fabric and home care, baby, feminine, and family care. And what I would say overall, if you look all the way on the right, what's really growing a lot in terms of organic volume, organic sales, you can see healthcare. You can also see fabric and home care. Now, what I would say is this illuminates why is Unilever looking to buy that GlaxoSmithKline unit. The reason they're doing that is because they look at their competitors like Procter & Gamble, and they're deriving a lot of their growth through consumer healthcare products, and that's where Procter & Gamble is growing. And so I think Unilever looks at something like that, and that's why they're trying to make that strategic acquisition. Unfortunately, GlaxoSmithKline just does not want to let go, and I hope from here Unilever doesn't increase the price anymore. I don't want them to make a foolish move or a foolish acquisition, but that's why the stock is down now, because people are probably still concerned that they're just searching for growth, and they're willing to buy growth at almost any cost. And so that's why the stock is languishing. Let's keep going. As you can see on the screen right now in the next screenshot, I have another thing I want to share. This actually goes back to Unilever. We see that it's in euros. Let's just talk about debt management. You can see that they have something called net debt, which they're looking at liabilities. They're subtracting out cash. They're kind of looking what's their net debt. Thankfully, over time, Unilever is actually reducing net debt. That was something really nice I like to see. And when I was looking at Procter & Gamble's balance sheet, I didn't think it was too dissimilar than Unilever, so I didn't see any red flags necessarily here with the net debt levels that Unilever has, but I think analysts are concerned that if they were to make a major acquisition, could they even pull it off, because it would take on a ton of debt to go ahead and accomplish that. Now, with that, I want to go into the full balance sheet at Unilever to close out the video today, to give just a little bit more picture around what's going on with Unilever right now. As you can see on the screen in front of you right now, it actually looks pretty similar to a US balance sheet, more or less. They have similar concepts like goodwill, intangibles, and property, plant, and equipment, so on and so forth. Their current actually, what's funny is they start with non-current assets, and so that's a little different. Usually I see current assets first, but non-current is about 53 billion, and you can see current is about 17 billion. And so you can see over time assets are going up. That's generally a good thing, but also I would point out that there's a good concentration of goodwill and intangibles. I think when I was looking at Procter & Gamble, it was not so dissimilar, similar concepts. You can see the liabilities there, current liabilities. One thing I would say is I feel like their current financial liabilities are pretty high. That's a little higher than I'm used to seeing. So if there's one red flag on here, perhaps it's under current liabilities. It's they got a lot of current debt, current liabilities, financial liabilities. Seems like a little bit more than I would be used to seeing. And in particular, like these trade payables and other current liabilities, that's where I'm seeing it really pop up. It's really in that trade payables. It just seems, boy, that's a little bit higher than I'm used to seeing. And overall, the current liabilities are kind of mapping up to be a high number. In fact, they're not so dissimilar from non-current liabilities, which are more reasonable and look kind of more standard. And so certainly they have a positive equity and assets are higher than liabilities, but they do have a lot of goodwill and intangibles in there, which are inflating assets. But again, if there's one thing I was going to pick apart here, it would be kind of the current liabilities. If I were to dig in a little bit deeper, it's a bit more than I would like to see in that bucket. And so again, it tells me, should they be making a big acquisition here, given how the balance sheet is right now? Could they pull it off? Probably, but I'd like to see them not make a big acquisition. Let's find some organic growth, Unilever. And you've already been shuffling the deck quite a bit, leaving this kind of dual structure, Dutch UK structure. You've already got that kind of fresh and new. And so if I were to give management my opinion here, I'm not so sure a big acquisition would do this company a lot of good right now. But then again, I'm not as intimately familiar with the company as the folks working at the company. But that's why Unilever is on sale, and we can all see why it's clearly on sale. And it probably warrants a PE less than Procter & Gamble, down in that 20 range. But should it be in the 17s? Probably not. And certainly that 4% starting yield is good, but the payout ratio is high as well. It's a core-ish kind of stock for me, certainly top 20, top 25 position for me, but it's not top 10, and now you all know why. If you enjoyed the video today, please go ahead and smash the like button. Share in the comments below what you think about Unilever, what you think of my analysis. Is there anything else that you found at home about Unilever you want to share with the community? Put it in the comments below. I'll be forever grateful. Don't forget to subscribe as well. And also, everyone, I have an awesome Patreon. I share my stock portfolio over there with the percentage allocation to each of the positions. I have bonus videos. I share my stock trades. I share all kinds of bonus content. Check out the pinned comment to join other members of the community over there on my Patreon, and it helps support me in what I'm doing here on YouTube and beyond. It means the world. I'm grateful for all of my patrons and all of my subscribers here on YouTube. Before I leave today, in terms of a full disclosure, I'm long the stocks mentioned today. I'm long Unilever, ticker UL, Procter & Gamble, ticker PG, McDonald's, ticker MCD, and Pfizer, ticker PFE. I own all of those stocks in my personal dividend stock portfolio. Also, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose a ton of money in the market. We're all seeing how volatile the market can be lately, but thankfully, dividend stocks, they've been weathering the storm really well. So far for me at least. And so share in the comments below what you think about the stock market volatility. But in terms of a friendly disclaimer, I'm just sharing my journey here, and it's possible to lose a ton of money. All right, everyone. Thank you for watching. Thank you for your support. I'll see you in the next dividend investing video.
Oh.